Welcome back to the Wall Street Podcast. Today, we're embarking on a deep dive into a recent Goldman Sachs research report. It focuses on CATL's 2Q25 earnings, released just this morning, July 34th, 2025, around 6:50 a.m. Hong Kong time. The headline seems to be an earnings beat, but with some definite mixed signals, particularly around battery unit gross profit.
That's right. Let's break down those numbers. CATL reported 2Q25 revenue of RMB 94 billion. Now, that was actually 10% below Goldman Sachs estimates.
Okay, so a miss on the top line.
A miss there, yes.
Yeah.
But the net profit came in at RMB 16.5 billion, which was 6% above expectations.
So the beat came from below the revenue line.
Exactly. It looks like stronger than anticipated financial gains and some good operating expense savings drove that beat. Battery sales volume was around 150 gigawatt hours, which was also a bit light, about 5% below estimates.
And the key metric, that unit gross profit.
Right. The implied 2Q25 unit gross profit, basically the profit per kilowatt hour, landed at RMB 135. That was 10% below what Goldman Sachs had penciled in and marginally lower than Q1 as well.
Okay, so revenue and volume slightly missed, profit beat due to other factors, and profit per battery slipped a bit. What are the main takeaways Goldman Sachs highlighted?
They pulled out three key things. First, that mixed picture on battery unit gross profit, the GP. The blended unit GP did decline slightly, as we said, to RMB 135 per kilowatt hour. And the battery average selling price, the ASP, was revised lower to RMB 573 per kilowatt hour.
Signaling that pricing pressure you mentioned.
Precisely, especially in the domestic market. Goldman Sachs now expects that China domestic EV battery unit GP won't bottom out until 2026. That's a pushback from their earlier 2025 projection.
So the competitive heat remains high domestically. What's the second point?
Second is the capex trend. Capital expenditure, it's definitely trending upwards. CATL's relative capex share compared to peers is projected to jump pretty significantly from about 13% in 2024 to an estimated 24% in 2025.
Wow, that's a big increase.
It is. And this isn't just projection. It's supported by looking at their prepayments for equipment and construction. It's an aggressive investment strategy aimed squarely at gaining market share. And it's particularly effective, when Tier 2 players, the smaller competitors, are really struggling with profitability.
Squeezing the competition through investment. Got it. And the third takeaway?
Third is solid-state batteries. Management reaffirmed they're leading the R&D push here. They're still targeting 2027 for small-scale production. But Goldman Sachs cautions it's not likely to be a near-term earnings driver. There's still refinement needed, supply chains to scale up.
So more of a medium to long-term story for solid state.
That's the view. In the meantime, expect other tech like fast-charging LFP, their free dual power system, and sodium-ion batteries to roll out sooner, perhaps in the coming quarters.
Okay, let's dig into that first point a bit more, the domestic market pressure. What is the absolute core issue hitting CATL's battery unit gross profit there?
Well, it really boils down to intense pricing pressure. The domestic China market is extremely competitive, particularly at lower price points. This directly leads to that slight dip in the blended unit GP and forces them to accept a lower average selling price. So for you, the takeaway is that the domestic competition isn't easing up as quickly as perhaps hoped, meaning margins there might stay compressed into 2026.
Right. Now, connecting that pricing pressure to their strategy, how does this big ramp up in capex, this investment, align with trying to maintain their market position against competitors, especially given those tight domestic margins?
It's actually a very direct strategic response. The upward capex trend, backed by those large prepayments we saw, is a clear signal. CATL is using its financial strength to invest heavily, aiming to solidify and likely expand its market share.
It's an offensive move then.
Definitely. Think about it. This level of spending puts enormous pressure on smaller competitors. Those Tier 2 players often don't have the same access to capital or the free cash flow to match this investment pace, especially when their own profitability is already under pressure. It widens CATL's competitive moat.
That makes a lot of sense strategically.
Exactly.
Okay, let's switch gears to valuation. Goldman Sachs has this split rating, buy on A shares, but neutral on H shares. Why the difference, and what's driving that H share premium?
Yeah, that's an interesting divergence. They kept the buy on the A shares listed in mainland China, target price RMB 328, but they downgraded the Hong Kong-listed H shares to neutral, target HK $436, citing valuation. Now, that H share premium, which is around 20%, isn't just about the company's fundamentals.
So what else goes into it?
Several factors. One is the much smaller free float of H shares, only about 3.4% of the total shares outstanding. Scarcity plays a role. Then there are differing shareholder structures, potentially less foreign exchange uncertainty for some global investors holding HK dollars versus renminbi. And crucially, H shares are just more accessible for many international investment mandates and strategies.
So it's partly a structural and accessibility premium, not purely performance-based.
Exactly. You could call it a sort of convenience premium for certain global investors looking for easier access or maybe specific currency exposure. That's factored into the relative valuation.
Understood. So looking forward, what's the overall outlook from Goldman Sachs?
They're still projecting pretty strong growth, a 24% earnings per share compound annual growth rate, or CAGR, from 2024 out to 2030.
Yeah.
That's driven primarily by volume, a 22% volume KTR, but also by gradually expanding unit gross profit over that longer time frame, likely helped by overseas growth and potentially easing domestic competition eventually.
And what should investors watch for? Key catalysts.
Goldman Sachs points to a few things. Consistently positive quarterly earnings results, naturally. Strong volume growth, particularly in overseas markets where margins tend to be better. And any signs of supply tightness emerging in the battery market could also be a positive catalyst for the stock price.
Okay. So final thought here, bringing it together. We have CATL facing domestic price pressure, but investing very aggressively in capacity, while also pushing forward on next-gen tech like solid state. How might their global dominance evolve if these domestic pressures do persist? But maybe their higher margin overseas expansion really picks up steam faster than expected. That interplay between domestic drag and international growth seems key. Something for you to consider for your own analysis.